Over £100 billion was withdrawn from UK banks in a matter of days during past financial crises. Not years, not months, days. Now imagine waking up tomorrow, opening your banking app, and seeing your balance frozen, or worse, reduced. Sounds dramatic? That's exactly what thousands of worried savers have been asking since headlines began screaming about a new UK banking rule that could legally use customer funds during a financial emergency. But how much of this fear is fact, and how much is clever clickbait? Here's the unsettling truth. Under certain extreme conditions, banks do have powers most people don't fully understand. The rules were strengthened after the 2008 financial meltdown to prevent total economic collapse. But buried in the legal language are terms like bail-in, resolution powers, and institutional failure. Confusing? Absolutely. Dangerous? Maybe, but not in the way you think. So tonight, we're breaking it down clearly and calmly. No panic, no exaggeration. Just a real story about what could happen to your savings and what you can do right now to protect them. Number 1. What is this new banking rule everyone is talking about? After the 2008 financial crisis, when major institutions collapsed and governments had to step in with massive taxpayer-funded bailouts, regulators decided something had to change. That's when the UK introduced stronger emergency powers under the Banking Act, overseen by the Bank of England. The goal wasn't to threaten your savings. It was to prevent the entire financial system from crashing again. One of the most misunderstood tools created during that reform is called a bail-in. Now pause for a second. This is where headlines get dramatic. A bail-in means that if a bank is on the brink of failure, regulators can force losses onto the bank's investors and certain creditors instead of using taxpayer money to rescue it. Notice something important? The primary target is shareholders and bondholders, not everyday savers. That distinction rarely makes it into viral posts. But here's where confusion spreads. If someone holds money above the protected limit, or keeps funds in certain financial products that aren't covered, there could be risks in extreme collapse scenarios. That's why the UK also strengthened depositor protection through the Financial Services Compensation Scheme, which currently protects eligible deposits up to £85,000 per person, per bank. Think of it like a fire safety system in a skyscraper. The rule exists for worst-case scenarios, not everyday life. It's a containment strategy, not a money grab policy. So the real question isn't, can they take your savings overnight? The smarter question is, do you understand how your money is protected and where it isn't? If this breakdown cleared the fog for you, drop a comment with the word secure so we know you're protecting your future. We put serious effort into cutting through the noise, so take 1 second to subscribe. It's just one click, but it helps us keep bringing you clarity over chaos. Number 2. Could your life savings actually be wiped out overnight? Let's slow the panic down for a moment. For your life savings to truly be wiped out, several extreme events would have to happen at the same time. First, your bank would need to be on the verge of collapse. Second, regulators, under the supervision of the Bank of England, would have to activate emergency resolution powers. Third, you would need to have more than the protected limit held in one institution and not be covered by the Financial Services Compensation Scheme. That's not impossible, but it's far from a random overnight event. Here's what most viral posts don't tell you. Protected deposits up to £85,000 per eligible person per bank are legally shielded. That protection exists specifically to prevent ordinary savers from losing everything in a banking failure. Historically, during modern UK bank collapses, insured depositors are being compensated. The system was redesigned after 2008 to avoid chaos, not create it. The real vulnerability tend to affect large investors, unsecured creditors, and shareholders, not everyday individuals with standard savings accounts. Now ask yourself something honestly. Do you have more than a protected amount sitting in one bank? Many people don't, but some do, especially after selling property, receiving inheritance, or building long-term savings. The risk isn't sudden disappearance, it's concentration. And concentration is something you can control. So instead of asking, can they take my money, a better question might be, is my money structured safely? That shift in thinking changes everything. If this helped you breathe a little easier, comment clarity below. It tells us these deep dives matter. We spend hours breaking this down so you don't have to, so tap subscribe. It's just one click, but it keeps this channel alive and growing. Number 3. The real threat to your savings isn't what you think. Here's something most viral headlines won't tell you. Your biggest financial danger probably isn't a dramatic overnight bank collapse. It's something much quieter and much more consistent. Inflation, fraud, and poor diversification. Let's start with inflation. While your money sits safely in a savings account, rising prices slowly chip away at its purchasing power. It doesn't make noise. It doesn't send alerts. But over time, that erosion can be significant. Even when banks are stable and regulated by institutions like the Bank of England, inflation operates in the background, reducing what your money can actually buy in the real world. Then there's financial fraud. Scams, phishing emails, fake banking texts. These are growing far more common than institutional bank failures. Criminals don't need new banking rules to access your money. They rely on urgency, fear, and distraction. And during times of economic uncertainty, scam activity often increases. And finally, concentration risk. Keeping all your savings in one place, even if it's protected by the Financial Services Compensation Scheme, may not be the smartest long-term strategy if your balance exceeds insured limits. So ask yourself this: are you more worried about dramatic headlines or the silent risks already affecting your money? The smarter savers focus less on fear and more on strategy. If this gave you a new perspective, comment strategy so we know you're thinking long-term. We invest real time and research into every video, so please subscribe. It's one click for you, but it helps us keep delivering clarity you can trust. Number 4. What you should do right now to protect your money. Now that we cut through the noise, let's talk about something far more important than fear: action. First, check whether your bank is fully regulated in the UK and covered by the Financial Services Compensation Scheme. This protection covers eligible deposits up to £85,000 per person, per bank. If you have more than that in one institution, consider spreading your savings across multiple regulated banks. It's a simple move, but it instantly reduces concentration risk. Second, turn on every layer of security available: two-factor authentication, transaction alerts, biometric logins. Most fraud succeeds not because banks collapse, but because security settings are left unused. Think of it like locking your front door but leaving the windows open. Third, understand where your money actually sits. Is it in a standard savings account, a fintech app, an investment product? Not all financial platforms offer the same protections. Take 5 minutes today to verify. Don't assume. And finally, build awareness instead of anxiety. Institutions like the Bank of England have crisis frameworks specifically designed to protect financial stability. Panic spreads faster than facts, but preparation beats both. Here's a powerful shift. Instead of asking, "Can they take my money?" start asking, "Have I structured my money wisely?" Because confidence doesn't come from headlines. It comes from understanding. If you're taking control after watching this, comment protected below. We genuinely want to see who's leveling up. We put serious effort into researching and simplifying these topics, so please subscribe. It's just one click, but it helps us keep producing content that empowers you. Number 5. Why panic is more dangerous than policy. Let's end with something most people overlook. Panic itself can be the real threat. Financial systems are built on confidence. When people trust a system, it functions smoothly. But when fear spreads, especially through dramatic headlines and viral posts, rational thinking often disappears. And history shows us that panic-driven decisions can cause more damage than the policies people are afraid of. During past financial crises, bank runs didn't start because everyone lost their savings overnight. They started because people believed they might. That belief alone was enough to trigger mass withdrawals. Today, UK banks operate under stricter capital requirements and regulatory oversight than ever before, with supervision connected to the Bank of England. Safeguards like the Financial Services Compensation Scheme were specifically strengthened to protect everyday depositors and maintain stability. But here's the psychological trap. When we hear phrases like new rule or emergency powers, our brains jump to worst-case scenarios. It feels urgent. It feels immediate. Yet in reality, these mechanisms exist as containment tools, rarely used, heavily controlled, and designed to prevent collapse, not cause it. The most powerful financial position you can hold is informed calmness. not blind trust, not blind fear, calm awareness. So before reacting to a headline, pause and ask, is this designed to inform me or alarm me? Because smart financial decisions are rarely made in a state of panic. If you value clarity over chaos, comment calm and informed below. It lets us know this kind of content matters. We put serious time and research into every video, so please hit subscribe. It's one simple click, but it helps us keep cutting through the noise for you. Number 6. The one scenario where you should pay close attention. Now let's talk about the scenario that truly deserves your attention. Not panic, but awareness. While protected deposits under the Financial Services Compensation Scheme are designed to safeguard most everyday savers, there are situations where people unknowingly step outside that safety net. And this is where understanding becomes your greatest asset. If you hold more than £85,000 in a single banking group, the excess amount may not be covered. Many people don't realize that some banks operate under the same banking license, meaning your money could technically be sitting under one protection limit even if the brand names look different. That small detail can make a big difference. Another area to watch: certain investment-style products offered by banks or financial apps. Money placed into stocks, bonds, or alternative assets does not carry the same deposit protection. Those products come with market risk, and that completely separate from bank failure risk. Finally, always verify that your institution is authorized and regulated by UK authorities connected to oversight from bodies like the Bank of England. A sleek app interface does not automatically mean full protection. This isn't about fear. It's about clarity. Ask yourself, do you know exactly where your money sits and under which license it's protected? Because the difference between confidence and vulnerability often comes down to details most people overlook. If this opened your eyes even a little, comment "Details matter" below. We truly want to see who's paying attention. We put serious effort into researching and simplifying this for you, so please subscribe. It's just one click, but it helps us keep empowering smart decisions. Number 7. The calm plan smart savers followed. When uncertainty rises, smart savers don't panic. They prepare. They understand that financial systems are built with layers of protection, oversight, and contingency planning. Institutions like the Bank of England don't wait for collapse to happen. They run stress tests, crisis simulations, and regulatory reviews specifically to prevent systemic failure. That preparation is happening quietly in the background, even when headlines scream otherwise. But smart savers don't rely only on institutions. They build their own calm plan. First, they diversify across regulated banks to stay within the £85,000 protection limit backed by the Financial Services Compensation Scheme. Second, they separate emergency saving from long-term investments, so short-term stability isn't exposed to market swings. Third, they stay informed, not addicted to panic-driven news, but grounded in verified information. Here's the difference. Reactive savers move because of fear. Strategic savers move because of structure, and structure creates confidence. Ask yourself this: if financial uncertainty increased tomorrow, would you feel anxious or prepared? Because the goal isn't to predict every crisis. The goal is to build a system strong enough that even if turbulence happens, your finances remain steady. Confidence isn't built overnight. It's built intentionally. If you're choosing preparation over panic, comment "calm plan" below. We genuinely love seeing this community think smart. We put real effort into researching and simplifying complex topics, so please subscribe. It's one click for you, but it keeps this channel growing and empowering others. Number 8. Final reality check. Should you be worried? After everything we've broken down, here's the honest conclusion. Most people don't need to worry. Everyone's screaming. Yes, the UK has powerful financial distribution rules. Yes, mechanisms like bailout nets exist, but they were created after the global financial crisis to strengthen stability, not to quietly confiscate everyday savings. Regulatory institutions such as the Bank of England operate within strict legal frameworks designed to protect the broader economy. And for retail savers, safeguards like the Financial Services Compensation Scheme exist specifically to maintain trust and security. The dramatic narrative suggests your money could vanish overnight without warning. The reality? Multiple layers of intervention, oversight, and deposit protection are built into the system before losses ever reach ordinary customers. But here's the empowering part. Your financial safety doesn't rely on headlines. It relies on awareness, understanding deposit limits, verifying regulation, diversifying intelligently, strengthening digital security. Worry drains energy. Information builds confidence. So instead of asking, "Is my money doomed?" ask something far more powerful. Have I taken the simple steps that put me in control? Because once you understand how the system works, fear loses its grip. And clarity? That's financial power. If this gave you clarity instead of confusion, comment "Clarity wins" below. We truly read and appreciate every response. We put serious time and effort into crafting these videos, so please subscribe. It's just one click, but it helps us keep delivering truth over noise. Number 9. The bottom line. Power comes from understanding, not panic. Let's bring this home. The phrase "your life savings could be wiped out overnight" is designed to trigger emotion. But when you step back and examine the structure of the UK banking system, you see something very different. Layers of regulation, oversight, and protection working together to prevent chaos. Institutions like the Bank of England don't operate in secrecy. They operate within carefully constructed legal frameworks designed to maintain financial stability. And for everyday savers, the existence of the Financial Services Compensation Scheme provides a defined safety net for eligible deposits up to £85,000 per person, per bank. That's not a rumor. That's policy. Could extreme scenarios exist? In theory, yes, but theory and probability are not the same thing. Modern financial safeguards were built specifically to avoid repeating past systemic failures. The bigger danger for most people isn't sudden confiscation. It's misunderstanding how protection works, ignoring deposit limits, or reacting emotionally to viral fear. Here's the truth most headlines won't tell you. Stability doesn't make noise. Protection doesn't trend. Calm rarely goes viral. But knowledge compounds. When you understand the system, you stop imagining worst-case scenarios and start building best-case strategies. And that shift alone changes everything. Because informed savers don't live in fear. They live in control. If you stayed until the end, comment "in control" so we know you're part of the smart money community. We put serious effort into researching and breaking this down for you, so please subscribe. It's just one click, but it helps us keep delivering clarity that truly matters. Number 10. Quick disclaimer. Stay smart. Stay responsible. Before we close, here's something important. This video is for educational and informational purposes only. While we reference official frameworks and protections involving institutions like the Bank of England and the Financial Services Compensation Scheme, this is not personal financial advice. Every person's financial situation is different. The amount you hold, the type of account you use, your risk tolerance, and your long-term goals all matter. What works as a smart strategy for one person may not be appropriate for another. That's why it's always wise to speak with a qualified financial professional before making major decisions about your savings or investments. Regulations can also change over time. Deposit limits, eligibility rules, and financial protections are subject to updates by regulators. Staying informed through official sources is always better than relying solely on headlines or social media posts. The goal of this video was simple: replace fear with understanding. Because when you combine knowledge with professional guidance, you make decisions from a place of clarity, not panic. And that's how long-term financial confidence is built. If you appreciate content that values facts over fear, comment "smart money" below. We truly put time, research, and care into every video, so please subscribe. It's one small click for you, but it helps this channel grow and keep delivering real value. Let's take a final breath and zoom out. What started as a dramatic headline, "UK's new banking rule will wipe out your life savings," turns out to be far less terrifying when you understand the full picture. Yes, the UK has structured financial resolution rules. Yes, tools like Bailout Nest exist, but they were created after global financial turmoil to protect the system, not to secretly target everyday savers. Oversight from institutions such as the Bank of England and deposit protection through the Financial Services Compensation Scheme form layers of defense designed to maintain stability and trust. That doesn't mean zero risk exists. No financial system in the world can promise that. But it does mean the narrative of overnight disappearance ignores the safeguard built specifically to prevent panic and protect eligible deposits. The real lesson here isn't about fear. It's about financial literacy. When you understand deposit limits, regulation, diversification, and security measures, you shift from uncertainty to confidence. Instead of reacting emotionally to sensational claims, you evaluate them calmly. Instead of imagining worst-case scenarios, you build practical safeguards. And that mindset changes everything. Because financial security isn't just about where your money sits. It's about how informed you are about the system around it. Headlines may come and go. Market cycles will rise and fall. But knowledge, that stays with you. And in a world driven by noise, being informed is one of the most powerful financial assets you can have.